Hello friends, last night the US Federal Reserve raised their rates by 75 basis points or 0.75%. What does it mean for India? Will it force the RBI's Monetary Policy Committee also to raise rates sometime towards the end of September 2022? What does it mean for our equity markets? What does it mean for you as an investor? This video is all about that bit. You see, in my humble opinion, people are looking at the Federal Open Market Committee's decision to raise rates to 3.25%, which is the highest after 2008. They are looking at it with a unifocal outlook. You have to take a 360-degree view of the financial markets to be able to arrive at the complete holistic picture. In this video, I want to talk about the implications for India. Number one, the cost of funds will rise. That is something I have been advocating on my social media accounts since many quarters. The time when central bankers could print unbacked currency and dump it into financial markets is over. That will create inflation that will never ever come under control. So the only other way is to take money from the people by way of deposits rather than print unbacked currency. And guess what? Inflation being high, the guys who are writing out the checks are demanding higher interest payments. Otherwise, they will not lend the money. So interest rates will rise and yields for fixed income investors need to go up, which means cost of funds will go up, corporate profitability will come down. Sectors like NBFCs, for whom money is both a raw material and the finished goods because they borrow from investors and lend it to their debtors, is likely to get more expensive, which means either they are able to pass on the rising cost of funds or their profit margins will compress. Any segment, any industry which depends on EMIs for sales, just think of the number of products that you buy and make down payments for, vis-a-vis what you have to buy on EMIs mostly. Anything that is purchased on EMIs will become more expensive and possibly demand for it might go down. The aspect that I'm talking about now is very, very critical. The US dollar will become stronger because the US has increased their interest rates. Why? Because money will come into United States and it will deploy itself in the fixed income market, and overseas money coming in means the dollar will become strong. What does it mean for you and me in India? Anything that we buy which is imported, right from our cell phones to petrol and diesel and gas and crude oil, will become more expensive even if prices don't rise in the overseas markets, because the dollar being the invoicing currency has become strong and the landed cost of these goods will become higher. To that extent, emerging markets including India face the challenge of imported inflation. The US is now exporting its inflation and we are importing United States imported inflation, right? And what does it mean for the bond market? Remember, this is a 360-degree video. You see, the reason why the RBI's Monetary Policy Committee, which is meeting towards the end of September to consider interest rate hikes here, will be forced to hike rates is because of the cash carry trade. You see, if America is offering 3.25% and we are offering 7%, there is a currency risk and there is a hedging cost involved in hedging the rupee versus the dollar. The differential between the two has gone down. Normally in a cash carry trade, if this is country A which is offering 5% interest and this is country B which is offering 10% interest, money will flow out of 5% economies and go into a 10% economy, all other factors remaining same. This is called the cash carry trade. Now, cash carry trade will become a little unviable for FIIs, which means the Indian Monetary Policy Committee of the RBI will have to raise rates in order to keep attracting FII inflows into the country, which means cost of funds even for Indian corporates will go up in spite of the fact that we may or may not want to hike rates. But because the US has hiked rates, we will be forced to probably hike rates later at the end of this month. The implication analysis in this video that I'm trying to make for you is that fixed income will suddenly start to demand attention of the investor. So far, in the last 3 or 4 years, we have been saying that there is no other alternative or TINA factor for stock markets, because look at the real effective yields on fixed income securities adjusted for inflation. It's falling constantly and it's negative, and therefore you have to invest money in equities. That situation may not remain forever. As interest rates start to go up, people with smaller risk appetite might withdraw money from equity markets and go into debt markets. So that is a small possibility. And those of my viewers who keep asking me, Vijay, you are saying that the Indian markets will continue to remain outperformers. What about that view? Hey, I stand by that view. The Indian market will continue to remain relative outperformers as compared to their Western market peers. What does relative outperformance mean? It simply means that if the overseas markets are falling 5%, we will fall 2%. And if the overseas markets are rising 2%, we will rise 5%. Relative outperformance means falling less and rising more when the tides turn. So will India be a relative outperformer? I'm betting my money that India will continue to remain a relative outperformer, which is why you should not be fearing the RBI's Monetary Policy Committee's rate hike, if any, towards the end of September. If anything at all, I would consider it as a positive move because it is the need of the hour. Practical realism tells you that you must change your sails as per the winds in the ocean. That's what a good sailor does. And that's what we should be hoping for. On this cheerful note, I'll bid goodbye to you, not before reminding you to click like on this video if you liked what you saw. Subscribe to my YouTube channel if you haven't already done so. And in the comment section, do let me know what you think of this video and help me reach out to fellow like-minded smart traders like yourselves by sharing my video with your friends and family and your social media groups across platforms. Thank you for your patience in being with me in this video till we meet again in my next. This is Vijay Bhambwani signing off for now. I wish you have a very, very profitable day ahead. Bye-bye.